Welcome to Boss Talk. My name is Jim Parker. This is my business partner, Carey Sobel.
Today's episode of Boss Talk is financials, the cornerstone of selling your business. And we can talk about the intangibles of selling your business all day long, but what is objective, what is black and white in your business is the financials. I think it's the most important part of any business when you're selling that business.
It starts with the financials and it ends with the financials. It's the cornerstone of selling your business.
Yeah. And
first thing that sellers are going to look, or buyers are going to look at.
And it's having organized financials, right? Sometimes there's a business that's not doing well financially, but it could still sell for a decent valuation, right? And there's usually stories behind everything that's in the numbers, but having organized financials is critical. And when we talk about the process of financials, it's having organized financials before listing your business. It's having organized financials when you list your business, and it's worrying about the financials as you're coming up to closing. And what I mean by that is obviously leading up to when you sell your business, that's the financial historical performance of it, right? But then once you're going ahead and you're listing your business and you're selling it, you don't want to let your foot off the gas. You want to keep, the business performing and doing well, right? So it's all through the process. It doesn't start or stop at any point in time. It should go the entire time through to have nice, organized financials.
Absolutely. And this is the one area when I talk to a business owner for the first time, this is the one where I kind of zero in on, because this is the situation where I'm talking to a seller and I'm like, after I see their financials, I'm not gonna be able to sell your business, or gosh, I wish you would have talked to me a couple of years ago so we could have made some changes so you can maximize your sales price. Yeah. And a lot of times when I'm looking at their financials, I say, hey, this is how much you're going to get now. But if you make these couple changes, this is what you can make in the future if you sell in a couple of years. And the number one thing, Carey, is, look, I've been doing this for 25 years. I'm not naive. I know what small business owners do. Everybody does. It's not a hidden fact. But, small business owners tend to run a lot of personal expenses through the business. Yep. And that's what's going to hurt when you go to sell your business.
And I think in one of the previous episodes, I made the comment that you can really only win one time. You can win every single year when you reduce your tax burden by writing everything off, or you can win at the end when you have nice, clean, organized financials, and you don't have to tell a story about why this was buried in an expense. When you have nice, clean, cut, organized financials, you're typically going to get a higher value for your business.
Yep, and better terms.
And we talk about that all the time. It's not just the price that you get, it's the terms, it's the structure of the deal. But, before we even have dialogue with a business owner, right? If it was just an email exchange, and we would probably have some dialogue before they were sending us their financials. But even if we didn't hear about anything aside from just looking at a couple financial statements or tax returns, we have a general idea of the health of the business, because the most important thing are the numbers that are on a business's tax returns.
Yep.
How do you feel about that statement?
Yep. No, I think it's very fair. And, Carey, I want to drive this point home to people that if you're listening to this, because I know how it is. You're running, personal expenses through the business. And the thought process is, I don't want to pay all this money in taxes. And all that's provable. Once I go under contract with a buyer, I can behind closed doors, I can show them all this. I can show them all the track records, and I can show them that those were personal expenses. But the truth of the matter is, and I've been doing this for 25 years. When I first started doing it 20 some years ago, buyers were like that. They were like, hey, let me see the gross sales. They could figure things out. I think they were more street smart. But today's buyers, what they want to see the tax returns, bank statements, merchant service statements, all the other financial information, and they're less willing to buy into the fact that you have personal expenses running through the business. Some of the things they will, some of they won't. And a lot of times it's hard to really prove at the end of the day what's a personal expense and what's not a personal expense.
Sure.
And if you're a business owner and you're thinking about selling in the next couple of years, run your books clean. Do not run any personal expenses through the business. And I'm going to say, even if you're not selling your business, I think you should do it anyways. It's just, again, I'm not being judgy, but you never know when you'll need a bank loan. You'll never know when you need to sell, because not everybody has a planned sale.
And you most certainly won't know when you're going to get audited.
Yeah, exactly. And one more thing. I'm sorry, Carey. If you're in the highest tax bracket possible, that dollar that you are writing off that's a personal expense, or that dollar that you got in cash that you're not reporting, if you're in the highest tax bracket, you're saving 37 cents on that dollar. But when you go to sell your business, that same dollar you're saving 37 cents on, if you're on the highest tax bracket, you could be losing out on $3, $4, $5 or more on that same dollar.
That's a great illustration too. Yeah. And we'll come back to add backs and personal expenses, but let's talk about your financial team, right? Mm-hmm. So business owners, small or large, probably have a different looking team. Mm-hmm. The one common denominator is probably a CPA, a person that actually files your tax return. Unless you're a TurboTax or Quicken or one of the, do it yourself. And I think most business owners aren't doing that. Mm-hmm. I'd say 90%, at least 90% are probably they use a CPA. Aside from a CPA, who's on your financial team?
Well, I find a lot of times the person either has a bookkeeper besides their CPA or their spouse. A lot of times I see the wife is running the books and doing the books.
I've seen that a lot too. And when you say bookkeeping, you're talking categorization of expenses and income.
Doing AR, doing AP, maybe running payroll,
P&Ls.
Keeping track of things on the QuickBooks.
Yep.
And what's nice about that when you have a situation like that is that when you go under contract with a buyer, the buyer's going to have an opportunity to do the due diligence. So having a spouse that you can trust, that knows that there's a sale going on, being able to run the reports that the buyer or the buyer's CPA wants, that's fantastic. Because they're going to be wanting, different balance sheets and profit and loss statements and, whatever it is, general ledgers, whatever it is. And, having somebody that knows about the sale, sitting in the back room printing that off, that's fantastic.
Yeah. I think a third member of the financial team would be when selling your business is us as business brokers. Yeah. And we are only as good as business brokers as the financial information that's put in front of us that we use to provide a broker opinion of value. Now, we are not providing certified valuations. We provide a broker opinion of value. We're not designated to do it from a accreditation standpoint. But again, the process for a business owner to get certified financials is different than just providing, a couple QuickBooks P&Ls and then giving it to your CPA to get, a tax return done. So, when we go through the process and we're working with the seller, we collect a certain amount of information, financial information. Let's talk about some of the financial statements involved in not just a business 101, but like when we're selling a business. So obviously tax returns. We talked about profit and loss statements. How important is a balance sheet?
Balance sheets can be very important. So balance sheets, it tells us a lot. It tells us like what, how much the furniture, fixtures, and equipment is worth, or approximately. Sometimes the balance sheets are wrong. It tells us, what kind of inventory, how much inventory is being kept in the business, how much is being kept in the savings accounts and the checking accounts of the business. And, if we're talking about a business that is a bigger business and we think it's going to be a working capital situation that's really going to creep into the business, like the working capital could be really high, and that's going to have to be included in the asking price of the business. So this would be bigger businesses. The balance sheets would help us determine what that working capital is. So we might then ask for 12 months of balance sheets, a monthly balance sheet for the last 12 months, or a balance sheet for the last 24 months, or, it could be quarterly for the last year, whatever it is. But, using those balance sheets to help us determine what that working capital is.
And a profit and loss statement is kind of a cumulative review of how that business has performed up until that time, whereas a balance sheet is kind of a snapshot of the health of the business at that one given time, right?
Absolutely.
So when we're doing working capital, or we're looking at average AR, whatever, we may look at a balance sheet at the end of each quarter over the course of a couple of years and take an average so we can find out what is your typical accounts receivable, what is your typical inventory. And those are the things that we use to calculate some more complex business.
Because it fluctuates. It fluctuates depending on the time of the year. Absolutely.
So in balance sheets talk about, capitalization and debt to equity and shareholders equity. So that there's a lot of things that the balance sheet teaches you. And it's actually funny because, studying, the financial classes that I did in college, and I can't say that I learned a lot in academia. I kind of breezed through the balance sheet stuff. I just didn't really pay attention to it. And now it's something that, I've spent a lot more time diving into, because as we sell larger businesses, they become more and more important. Yeah. I think the typical business owner, when you ask them for a balance sheet, they go, what the hell is that?
Yeah. It depends on the size of the business, because, for me, a business that is going to sell for, has enterprise value, a smaller business that's going to have an enterprise value of $750,000 to maybe $3 million. Chances are whoever's buying that's going to be an individual buyer. Mm-hmm. They're going to be getting an SBA loan. Mm-hmm. So, I might ask for some profit and loss statements and some balance sheets, but I'm really going to zero in on the tax returns.
Yeah.
Because chances are that buyer is going to be getting an SBA loan, and that's what the lenders are going to be looking at. They're going to be doing the SBA loan is they're going to be zeroing in on the tax returns.
That's right.
So I want to do my recasting, my add backs, my valuation off the tax returns, get it pre-qualified by an SBA lender off those tax returns. But if we're talking about a bigger business, a business is going to sell for $4 or $5 million in enterprise value or higher, I like the profit and loss statements more than the tax returns because they tend to be more detailed.
Yep.
Might be in a situation where the accrual base, on a P&L is going to show a truer picture of how the business is performing.
Let's dive into that.
Because on tax returns, usually they're on a cash basis.
Yes. Yeah. That's an important point to dial in on. So let's talk about the difference between cash and accrual basis. Cash basis accounting is essentially you recognize revenue and you recognize expenses as they happen. As you actually receive or spend the money.
Right.
Accrual is based on when it's billed or when it's invoiced out.
Yep.
Right. So this gives flexibility for a business owner to be able to kick the can a little bit on certain revenues or maybe grab additional expenses. Because if the year cuts off whenever it may be a calendar or fiscal year and a business owner is reporting on cash, the end of December, maybe they build out $500,000 in new jobs that they've signed, but their P&L's on an accrual basis, which means they're recognizing that their P&L looks healthier. But then when you go to pay taxes and they file on a cash basis,
return, they're filing a cash basis.
That $500,000 is not on that year's tax return.
That's why when we're doing recasting and the valuation of the business, we either have to look at everything on a cash basis or we have to look at everything on an accrual basis. We can't, mix and match those two.
That's right.
So if I'm working on a deal, let's say that I think is going to sell for around, a couple $1 million, it's going to be an individual buyer doing an SBA loan. I want to work off the tax returns because that's what the banks are going to be looking at. I don't want to be caught with that surprise.
Yeah,
I want to know, and the lenders are going to want that. So it's off the tax return. And when I'm doing that and I'm looking at those numbers off the tax return, Carey, I'm sorry, I forgot what I was going to say.
Well, I mean, really, what we have to do is we have to normalize those financial statements too when you're talking about cash versus accrual. So on a tax return, it's almost always. Do you often see anything that's tax return that's accrual?
I do. Once in a while I do. If you go to
it's rare, right?
Yeah, you go to the, just if you're listening to this, you go to the front page, let's say it's an S Corp, you go to 1120S, you see the front page where you have the gross sales and all the main expenses. You go to page 2, right there at the top, it says, is this an accrual based, cash based, or, other
modified? And
you can choose what it is. And so you can always check to see what it is.
So
when I'm doing tax returns, I'm doing off the cash, but then sometimes I'll also have to be working on this. I know this is what I'm going to say. So I'm asking those tax returns because it's going to be an individual buying the business, but then I might be asking for a profit and loss statement that's, trailing 12 month or something like that. Mm-hmm. I have to make sure that P&L is on a cash basis if the tax return's on a cash basis.
That's right.
Or I have to make sure it's on accrual if the tax return's on accrual.
A lot of times when I'm requesting, because at the end of every conversation about, hey, I might want to sell my business, can you help me? Tell me what it's worth. And that's typically how our first conversation goes. I make a request list of the things I would like to get. And if I actually requested everything I need to put a business to market on the first meeting, the seller's probably going to tell me to kick rocks. This is too much information. Yeah. I want to go. So I typically tiptoe into the things that I need: 3 years tax returns, current year P&L. I may say 3 years tax returns and corresponding P&Ls, right? Because then you can actually, like you said, dive into the details inside of a profit and loss statement that a tax return is just not going to provide. So I think a P&L is typically going to give the best read on what's going on in a business, but a tax return for the businesses that we sell is probably the most important because it allows for financing, right? Some other things that we typically get that are considered important documentation from financials or financial verification. We have cash flow reports, bank statements, POS reports, DR-15 forms,
merchant service statements,
maybe even down to actual invoices. It's what level of due diligence is a buyer going to do once a seller says, here are my IRS verified tax returns. Here is my corresponding P&Ls to support how I filed my tax return. But then you may want to dive a little bit deeper. So they're going into your actual accounting software that shows your general ledger and it shows cash in versus cash out. The next step would be then the bank statements that fed into your accounting
the merchant
software.
service statements that fed into that, and then feeding into reports you're filing with the state, and then, going all up to the federal tax return.
It's just a whole line of items. And, a person doing a good deep due diligence will check as far back as they're actually able to do. And of course, it depends on the size and nature of the business. But those are kind of the common financials that are, included when we're going to sell a business. But I think it's important to talk maybe about normalizing financials. We talked earlier about personal expenses. So when we are actually taking a financial statement and we are going to what we call recast it or normalize it, we are accounting for one-time expenses that are anomalies. They're not recurring. For example,
an air conditioner on the top of the roof.
Put
two new air conditioners on top of the roof. That was $25,000 last year. That's unlikely to happen for another 10, 15 years.
Yep.
So we can add that back.
Maybe there was a repair that was done, you already gave an example of a repair. How about an addition? It's a music venue and they add an additional stage.
Yeah.
If they're not going to capitalize it, and we'll talk about what that means in a moment. Let's say they put a $25,000 stage in, and that $25,000 stage allows them to bring more people in to see more people performing, whatever. The new business owner will experience more revenue from an enhancement, a one-time enhancement that a seller paid for.
Mm-hmm.
There's a one-time expense. There is a huge lawsuit and the business had a $20,000 one-time lawsuit. That would be a one-time expense.
Yeah, but we'd have to dig it deeper into that and find out why, what happened.
Yes.
There'd be a lot of questions going in behind that.
Bottom line is there are one-time expenses, and while one-time expenses are normal, each one of them needs to be analyzed, and we need to figure out, should we add that back? Before we talk about other add backs, what do I mean by add back?
Oh, so basically add back is you're adding back to the net profit. So, you're looking at the P&L or the tax return, you're seeing the net profit, and now we're adding back things to that net profit. So, that air conditioning units you spent $25,000 on last year. Add it back to the net profit. We're actually right next to, the air conditioning units. $25,000 is being taken off the expenses, is being added back to the net profit.
Right.
And going through all the expenses like that and seeing what we can add back to the net profit to see how much somebody can make from that business if it continues to operate in the same manner.
So let's do an illustration. Business makes $100,000 net profit. And that business owner had a $25,000 air conditioning unit that they had to replace and a $25,000 stage that they built.
It's $150,000.
It's $150,000. Let's talk about what else we're going to add back to that.
Okay.
So you obviously have personal expenses. Let's talk about some of the common personal expenses that are maybe well accepted or not gray area. So you've heard the term EBITDA, earnings before interest, taxes, depreciation, amortization. The easiest things that you add back that are not considered personal expenses are depreciation, amortization.
Because those are non-cash expenses. So
interest.
We're adding back the depreciation, the amortization 100% because they're non-cash expenses. So say in that example, you've got 100,000 net profit. We add back 50,000 one-time expenses. And, now we're looking at
$50,000 depreciation and amortization.
$50,000 in depreciation and amortization. We can add back because it's a non-cash expense. However, what my question to the seller would be is, what kind of a capital expenditures are we looking at over the next couple of years? How much are you looking to reinvest? So if I'm talking to a lawn or a landscape guy, he might say, well, I'm good with my trucks. I just spent $400,000 in the last 24 months on trucks. My mowers are in pretty good shape. I spent another $100,000 on mowers. But then the 2-cycle equipment, stuff they're going to be burning out every year or every 2 years, that might be, I need $50,000 every year in those kind of expenses.
That'd be an example where you don't take the depreciation.
I would add back the depreciation 100%, but then I would create a line, CapEx, capital expenditures, and, I'd make sure that there's money left in there for the new owner to cover those costs.
And I jumped ahead of myself there. We probably should have waited to talk about EBITDA because then we can talk about, capitalizing something versus not. But let's talk about the owner benefit personal expenses that are add backs that we typically see. We can go back and forth round robin. So owner's automobile If the automobile is used for the business, registered by the business, they should definitely add it back. More times than not, owners adding back their auto anyway.
Yeah, it depends. It depends. Is that auto necessarily needed for the business? Would that stop the production? You know, so on a really, really small business, if that owner is using that truck to go to pull the trailer to go mow lawns,
that's an add back all day long.
You think so? I don't know. I look at it and I think that a new owner is going to need that truck, you know, to pull that trailer.
I see.
I think you got to mix the other way. If they have, you know, if that owner's truck is, you know, he's just taking it to work and back and the company's paying for it, that's an add back.
Yeah.
You know?
Yeah.
And then if you got 10 trucks that are, you know, all got gas in it, and then you're getting gas for your personal car and your individual, your spouse's car, we can't add that back because we can't. How do you split out where the gas is being used?
Yeah.
You know, on the business front and when you're using it on the personal front.
Sure.
You know, so the car insurance is kind of easy to split out. We can kind of add that back. But at the end of the day, like really, you know, you try not to run any personal expenses through the business, period. You know, I'm telling you, like a business owner would be like, but you know, I'm saving so much in taxes, but it goes back to you're saving cents.
Yep.
And you're losing out on dollars when you go to sell the business.
No
and
doubt.
It's not just the buyers you have to get on board, but you have to get the lending institutions on board.
And they're not giving credit.
And they're not giving credit for a lot of things like travel and entertainment. You know, that's a big thing that people run travel and entertainment through the business, meals and entertainment through the business. Both of those,
personal phones.
and personal phones. Lenders don't like adding that stuff back.
Mm-hmm.
I mean, buyers can buy into that, but lenders will not. So you're losing all that.
What are some other ones that you typically see?
Well, you know, I think the benefits is a big one. You know,
Health
insurance, you know, life insurance, you know, 401k or SEPs or things like that. Anything that's particular to that owner, we can definitely add back.
I see a lot of dues and subscriptions. I see Netflix accounts and Spotify accounts.
Yeah, I don't touch that. You just that's, you know, you're going to lose out on that.
What other items are common? I'm just trying to think of a couple more that we see often.
Yeah, I've seen everything over the years. I've seen people write their kids' college educations through their every personal expense you can imagine, from their mortgages to their food that they put on the table and everything. And I'm going to tell you, like, again, I'm not here to judge, but you know, you might have problems with the IRS down the road, but you're not going to realize that. That's like the biggest thing. If anybody's listening to this episode, to get is stop running personal expenses through the business.
Tell them.
Stop running personal expenses through the business. And you know what the thing is? You might talk to a broker that says, that's not true. We can add it back. Da, 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 da. You want to maximize first of all, only 10 to 20% of businesses for sale actually sell. So 80 to 90% of businesses for sale do not sell. And then on top of that, you don't only want to sell your business, but you want to maximize your sales price and you want to get the best terms possible. That's like the biggest message I want to get out to people right now. If you're thinking about selling in the next couple of years, get your financials in order. Get the personal expenses out of there. Stop trying to save pennies on the taxes, losing out on dollars on the sale. You're also going to set yourself up for better terms and keep your financials organized. Like you were saying before, know where everything's at. Know where you can get your monthly bank statements, your monthly merchant service statements. Everything should be organized for your business because the buyer, when they go under contract, they're going to do their due diligence. They want to verify if all that information you're putting in front of them is true and accurate. Yep. And on your end as the seller, not only do you want to make sure that that can get proved, but that you can find that information quickly. Yeah. And you're not spending 100 hours trying to find all that information. Mm-hmm. So you think about selling in 2 to 3 years, start getting prepared right now. It's not that much effort, not that much work, and it could increase your chances of selling and maximize your sales price.
Agreed. Let's talk a little bit about, both of these items that I'm going to bring up one after the other deal with P&L to balance sheet kind of conversion. So I think this is a hilarious thing that over the years, I've actually just provided the education versus just like kind of throwing my hands up. But I want all business owners to know that distributions are not added to your net operating income. They're not added as an add back to your financial recast. No. Let's talk about why that is. So at the end of a given year, a P&L or tax return tells you how you performed in that year. Okay. If you had $100,000 on the bottom line of your tax return, are on the bottom line of your P&L, and another 50 grand of add backs, one-time expenses, whatever. You made 150 grand that year. And a business owner goes, well, I distributed $100,000 to myself, so shouldn't I have $250,000? That came from your balance sheet. That came potentially from previous years when you made that money and did not distribute it. A distribution does not have anything to do with the net operating income of the current year. A distribution is money that you took from a bank account and put into your pocket, not based off of the performance of the business that year, not necessarily based on the performance. Anything to add on that?
No, you're absolutely right. If that net profit, bottom line, net profit is $350,000 net profit, bottom line, and you took a distribution of 100 grand, that 100 grand is part of that 350.
Absolutely.
Or it's, like you said, retained earnings from previous years.
Yes.
You don't see an expense line. This is how I always explain it, because sellers get confused or business owners get confused, and I can understand why. Is look through your expenses. Is there any expense anywhere in there that says distribution? And if there is, it's
doing your accounting wrong.
You're doing the accounting wrong. But yeah, you're right. But and there's no expense for that. It's coming out of the net profit, or it's coming out of retained earnings.
That's right. It's a perfect way to say it. And aside from distributions, another item is to talk about capitalizing something. You were talking earlier about, you always add back 100% of the depreciation and amortization. However, if you're purchasing equipment or you're purchasing something heavy machinery, typically one of the benefits of doing that is you get to depreciate it over a period of time. So when you acquire that, it becomes an item that goes onto your balance sheet as an asset, and you depreciate the asset over time. You get to deduct the depreciation from your taxable income, and you're essentially what's being called capitalizing that piece of equipment, or that FF&E. Contrarily, if you have repairs that you have to do to a restaurant or to a building, typically you're going to have these types of repairs every single year, and you're not buying an asset, you're doing a repair, right? Mm-hmm. So like the example I gave earlier when I talked about building a stage, you could depreciate a stage, you could capitalize a stage or something that you build a structure for, right? But you don't get to do both. So if you buy a piece of equipment, you're not going to get to put that piece of equipment on your profit and loss statement and deduct it as an expense. You're going to buy it, you're going to put it on your balance sheet, and you're going to depreciate it. Mm-hmm. So you don't get to do both. So I think that, when you're talking about, talk to business owner, I bought a lot of equipment this year. That's why my, financials don't look good. Well, that's actually not true. Yeah. If you look at both the balance sheet and the profit and loss statement, or whatever it may be, you can see the whole story there. But the point that you were making earlier is that if you are running a lawn care business and you bought 50 grand worth of new equipment, and you took the depreciation on it, but you did not take the expense on your P&L, you may make the adjustment that since they're doing that $50K purchase annually, that instead of getting the full $50K depreciated value, that you're going to deduct some of that based off of what you have to purchase on an annual basis.
Yes,
correct. Was that clear?
Yeah, no, that's clear. Yeah.
So, it's the way
I've done it both ways.
Yeah. The way that business owners treat assets, from capitalizing something and putting it on your balance sheet versus taking it as an expense and putting on the profit and loss statement, is something that business owners should educate themselves on.
Yeah. And then as brokers, I've done it both ways, where I'm adding back the depreciation 100%, putting another line item in there for CapEx. And I've also done it where I leave money in the depreciation to make up for that CapEx expense.
So if you do it where you're adding a line item back for CapEx, do you actually put it in your recast, or do you kind of put it below the recast?
I put it in the recast, and it's usually the last expense.
Under like total expense, operating expenses.
Yeah, and then it's like I put it as a negative expense. Negative expense meaning it's it's an addition. Yeah. And then we were talking about, so we got the add backs. We're adding back. One thing we didn't talk about was interest expense. Mm-hmm. We're going to add back interest expense 100% of the time, because the seller is going to pay off all their loans on the day of closing, and the buyer's going to be taking that over free and clear of the seller's loans. They might have their own loans, but they're going to be taking free and clear. So we can add back the interest expense.
I see interest expenses often, for credit cards, because they just missed a payment. Mm-hmm. That's also an add back, because typically you're going to say that you don't miss your payment. Yeah. But the majority of the time, the interest is on type of loans. And like you said, debt-free, cash-free, you're buying the business without any encumbrances on it. EBITDA, we covered depreciation, amortization, interest. We covered
one-time expenses. We covered benefits, mm-hmm. personal expenses. So I think the only other item that we didn't talk about was the owner's salary.
Yes.
And then, that's where the difference of an EBITDA, earnings before interest, tax, depreciation, amortization, or discretionary earnings comes into play.
That's right.
So you want me to go into it, or you want to go into it? Okay. So, determining what kind of buyer is going to be buying the business. If it's going to be a bigger buyer that's going to be buying the business and they're going to be buying it and putting a manager in place, we're going to be using an EBITDA number. And typically that's if the business is making $1 million bottom line of what we just talked about.
Correct.
If it's going to be $500,000 bottom line, then the chances are whoever's buying it is going to be a single owner operator. Somebody out there maybe in the corporate world right now, in their 40s or 50s, been kicking butt, doing really well in a management or a sales role, making good salary. It's got a good net profit, but going, you know what? I've always dreamed of owning my own business. I'm tired of making other people money. I'm getting older. If I'm going to do it, I want to do it now, but I don't want to start a business from scratch. I'm going to go out and buy a business, and they are going to get an SBA loan, and they are going to be an owner operator. Then we are using discretionary earnings instead of EBITDA. And doing an adjusted EBITDA or doing the discretionary earnings formula where we're taking the net profit plus the interest plus depreciation plus the amortization plus one-time expenses that we can add back plus personal expenses. Those all add up. The only difference now is that you can add back the salaries of the owner if you're assuming whoever's buying it's going to be an owner operator.
Correct.
So if it's one person owning that business currently and they're working full-time in the business, we can add back that salary 100% because the new owner is going to be working in that business. Or if it's a husband and wife team, we can add back one of their salaries, and then the other salary, let's say it's the wife's salary, the wife is making $125,000 from the business. We have to say, okay, we can add back the husband's salary 100%, assuming whoever buys is going to be taking over his role. And then they're going to have to hire somebody to replace the wife. And if the wife's getting paid $125,000, the question then becomes, what's the fair market salary? And if the fair market salary for that same position is $80,000, we can't add back the entire wife's salary. We're going to add back the difference of that 125 minus the 80.
That's right.
And we're going to add back 45,000.
And when you're doing a calculation that's adjusted EBITDA, essentially what you're doing is you're going to find out what is the cost, the market value cost for a CEO or a manager,
president or a manager, or somebody's going to actually run that business.
That's right.
So at the end of the day, if you look at those bottom line numbers, that EBITDA number is going to be lower than the discretionary earnings number because we're adding back the salary of that owner in the discretionary earnings number. So the DE number is higher than the EBITDA number. But when we're going to price the business, the multiplier on the EBITDA is going to be higher.
That's right.
And the multiplier in discretionary earnings is going to be lower. And then on top of that, when you're doing discretionary earnings number, we're assuming that the person's buying is going to be an individual buying the business, getting an SBA loan. The bank is going to be giving them working capital. So working capital is not included in the sale of the business. Where with an EBITDA number, you're dealing with bigger businesses that, buyers, private equity groups, industry buyers are going to buy. They're going to want the working capital. So the EBITDA number is lower. Working capital is not included or is included.
Is included.
On discretionary earnings number, working capital is not included. Discretionary earnings number is higher. But when you add those multiples to it, the multiplier for the EBITDA number is going to be higher. The multiplier for the discretionary number is going to be lower. So it's all going to kind of mesh out close to be about the same anyways.
Yeah. It's funny, as I'm listening to you talk, I'm thinking about the audience as we're talking about, so many different aspects of financials. And I'm going, this is why you hire, a team around you to help you lead you through these things. Well, so
you're absolutely right. And I'm sorry to cut you off, Carey, but you're absolutely right. Because when we're talking about the owner's salary, there's so many different scenarios that you can play in there. You can have the thing where you think you're assuming whoever's buys it can be a single owner operator. So you're doing a discretionary earnings number, but the owner is getting paid a salary but not working in the business. Or there's 4 partners and 2 of them are working in the business, 2 are not. Or nobody's working the owner's not working in the business. They have a manager. Like there's just on the owner's salary portion on the discretionary earnings,
There's so many variables.
There's so many different scenarios.
I sold a business recently that was doing 3-4 million in sales, and the CEO that ran the business was paying himself 50 grand a year.
Yeah.
So any way you look at it, you're doing a negative add back on discretionary earnings.
Right.
I mean, realistically, I mean, it's also contingent on the buyer. What is the buyer going to do? It could be a single individual owner operator buyer, maybe owner buyer, but not an owner operator buyer. And they're still going to go appoint somebody else to go run the business for them.
You don't know. And that's why we're coming up with either that adjusted EBITDA number or the discretionary earnings number, because we're saying, here's $700,000 in EBITDA or discretionary earnings. You got to figure it out. Whoever's looking at buying the business, of what you're going to take in, as an owner's salary, what you're going to take in distribution, what you're going to, what expenses like benefits you're going to run through the business. We're leaving it all there for them. But this is why, like, when I am talking in a public forum, I'm on somebody else's podcast or I'm at a conference and somebody's like, hey, raises their hand and they're like, hey, what's the multiplier on such and such business? It's hard because one,
they expect an answer like that.
Yeah, they expect an answer. But one is like every category has a different multiplier. Then you got things, the subcategories within the category that have different multipliers. And then the size of the business, the smaller the business, the smaller the multiplier. The bigger the business, the higher the multiplier. The same business, smaller, could be 1.5 times discretionary earnings.
Yeah. On
a bigger business, same industry, it could be 5 times EBITDA.
Yep.
Then you've got the problem too, is that you just spitting these numbers out. Do the people know how to apply those multiples by doing the add backs correctly?
They're typically going off gross sales.
Sometimes they're going off of gross sales, or sometimes they get things across. They're like, I already did my discretionary earnings, and and I look at them and I'm like, they're missing some things. They put some things in there they shouldn't, and that's why I don't like giving simple multipliers to somebody on the phone.
I usually don't.
I don't, because it just
you shoot yourself in the foot.
Yeah, you do. You do. I'd rather get all the financials, look at them, talk to the seller on the phone, ask them some questions, go back, finish up my broker's opinion of value. If it's a smaller business, a business is going to sell for under a couple $1 million, I'm going to go get it pre-qualified for an SBA loan, and then, go back to the seller and present the broker's opinion of value that way.
And any way you look at it, all the things that we're talking about, like we said, they are what is objective. What's subjective maybe is the valuation that you're going to use, but almost everything else is objective. When you're talking about, will the employee stay? How is the lease? What is your customer construct? Like anything that is number-based is objective, and everything else has a level of subjectivity to it. So this is kind of the most important part about selling your business. And I think when we're analyzing financials, one of the other things I wrote for us to talk was expense types. Because a lot of times you're looking at industry multipliers, you're looking at industry averages for cost of labor, cost of sales, percentage rent, all these different things. So maybe let's dive into some of the different expense types.
Yeah, go ahead.
So I have on here variable versus fixed, right? Your variable expenses are typically in your COGS or in your cost of labor or your cost of sales. Cost of sales would be the kind of parent category for it. And then I like seeing underneath there, in order to generate these sales, which is your top line, your cost to generate those sales, which is typically a variable, is labor and materials.
Labor on the field. So if you're talking about a landscape business, you're talking about in the cost of sales, the labor that's out there in the field doing the work, not the office people.
Correct. And that's a good way to look at it too, because let's think of a factory, and the factory produces widgets. All the people on the factory floor producing the widgets, that cost of labor will be above the gross profit line. Below that, maybe the fixed employee salaries, which are a fixed expense, which are employee salaries of admin, HR, somebody who's not directly contributing to the widgets being produced. They're a part of the business, right? So there's a variable versus fixed. And, I wrote the variable is typically above the gross profit line and fixed is below. Example of fixed expenses, your rent. That's not changing typically regardless of what you do. And your utilities may vary a little bit, but those are fixed expenses. You're having those no matter what. What other ones? Insurances. So, those are typically called operational expenses, right? So that's a big thing to variable versus fixed expenses. Percentage of sales, year over year, we're doing a lot of comparisons. So one of the things I wanted to bring up was seasonality. So when we're looking at a business and we're valuing a business, unfortunately for us, we don't provide valuations only in January when you just got your last calendar year's financials.
Yeah, right.
We do it at whatever time that we come across working with the seller. So if you have seasonality in your business, we're going to typically ask for a TTM or a trailing 12 months of the past few years to look at how your business is performing in the past 12 years from the day, past 12 months from the day that we're actually analyzing the financials to compare a year over year synopsis of a similar time period.
Yeah.
Right. That takes seasonality out of it. Maybe you're a business that has a huge Q4 because you sell a lot during the holiday season, but we're valuing the business before that part of the year. So we want to make sure we capture all seasonality in it, or businesses that have spikes and dips. So a TTM is a very common financial instrument.
Yeah. And, another thing is we're looking at percentages too, like the cost of goods, if it's 38% one year and 41% another year and 39%, and then all of a sudden it's 20%. Why did it go down so much? What was the reasoning?
Yep.
And why was it? And it's not just questions we're going to ask. Buyers are going to be asking this. Lenders are going to be asking this.
Yeah.
Are you just burning through inventory and you didn't buy any new inventory last year? So, we're just burning through what you got in there and, your profit margins are being increased. I mean, that's just not appropriate. They would have to be adjusted to price the business accordingly.
And when it's
going to get caught. It's not something but
sometimes it's not even intentional when people do it. They literally just have such a huge spike one way or another. And it's typically the smaller businesses where you see that. If it's a bigger business, you should be within a couple percent year over year. Even if it's an inclining or declining business, you should see like a very
and that's what we're looking at. I'm looking at certain expenses and I'm looking at, what is the percentage, year over year. And I'm also like the three biggest expenses in almost every business is, cost of goods, your labor, and your rent.
Yep.
So I'm really zeroing in on those three. I'm looking at every number, but those are the first three that I zero in. And then, obviously if you look at a business and business is making, $565,000 bottom line after we do all of our add backs, and another business, the same business type, is making $545,000 bottom line. So the first one's making $565, the other one's making $545 bottom line. Okay, I'm putting this together for a conference or for a workshop I'm doing this weekend up in Connecticut for an automotive association, and that's actually one of my boards. It says $565,000.
We got $20,000 difference, right?
$545,000 discretionary earnings. Which one's better? And I think the audience is going to be like, the 565 is better. But then I'm going to reveal on the next slide that was 2024, and we're going to have a 2023 column, a 2022 column, and that 565 is on the decline. Mm-hmm. The other business, that 545, even though it's $20,000 less, is on an incline. So the point in that is that where are you trending in your business? Mm-hmm. You're trending up or you're trending down. That first scenario you're looking at and going, 565 is a good number, but gosh, 2 years ago, if it was 640 and then it went to 610 and now it's 565, buyer's going to look at that and go, how far does it have to go down? Mm-hmm. Whereas that 545 could be going from 385 to 425 to 465. And the buyer's like, how far can that go? It can go all the way up.
Yeah. And while I want to say that the numbers provide a story, it's really the numbers provide a indicator for us that we have to ask what the story is behind it.
Yeah.
Right. Because the example that you just gave, there could be a number of reasons why that happens. But at the end of the day, if you see sales declining, it's not as good. So
you're hitting right on the head, because that's what I'm dealing with a lot right now, is that there is an artificial increase or an artificial decrease in a lot of businesses that we're dealing with right now because of COVID. COVID happened in March of 2020 is when it really hit the United States, but it really affected 2021 and 2022. Yep. I'm still looking at businesses where the business was either artificially inflated in 2021 and 2022 or artificially pushed back in those 2 years. And so then it's like you almost got to throw those years out the window. And sometimes you got to say, hey, I need your 2019 numbers.
I know.
And I'm going to ignore the 21 and 22 and 20.
It's funny because I remember in 22 and 23, we would say, let's throw away 2020, but that really was not the case.
Yeah.
It's interesting. 5 years past it that we're still dealing with that when we're doing
valuations.
valuations.
And we're still dealing with employee retention credits. I'm still seeing that pop up once in a while.
Yep.
Employee retention credits that they received in 23 or 24.
Well, it's a good example of a negative add back. Another thing that we should touch on is I'm seeing a lot of people that remember the BP oil spill.
Yeah.
I work with a business that got $250,000 check that they had in their gross income. They didn't even have it separated on their tax return that it was not a part of sales from the business. Right. As we further dove into it, I asked about the bump and they said, yeah, we got a $250,000 check from the BP oil spill.
I'm not a CPA, but I almost think that was probably categorized wrong by their
Absolutely it was.
CPA.
Absolutely it was.
Gross sales.
But again, us looking at trends, looking at numbers in a spreadsheet, we're able to say, oh, this is abnormal. We should probably dive into that.
Yeah. Well, that goes to another thing they're saying too. And we're looking at these financials, you see the other income at the bottom and the other expenses. A lot of times you got to ignore that. Like other income, a lot of times could be money that is made off of the sale of assets. We can't include that. Yeah. If you sold off $75,000 worth of company assets last year, that's not money made in the normal course of business. So we have to subtract that, and the same thing, like other income can also be sometimes like interest expense, credits. Or they made money off of some condo thing that they have. And we got to subtract all that out.
And it takes a wealth of knowledge and experience to be able to guide a seller about all of these things. And that's why financials are the cornerstone of selling a business.
They are. And you know what? The sellers, business owners out there going, well, gosh, they're looking at everything positive and negative. You should be thankful for that. You want us to, because the thing is that this is a national average, is that 50% of the businesses that go under contract for sale fall apart before they get to the closing table. They fall apart in due diligence. And that's not what happens with us.
Yeah.
I'm not saying we never have a deal fall apart, but you're doing this stuff up front. You're crossing your T's, you're dotting your I's, you're decreasing the chances of it falling apart, getting into the due diligence. So I know as a business owner, you might be like, well, I don't want all this negative stuff being added back. Like, let's show as much profit as we can. Well, you're just setting yourself up to, one, to fall apart in due diligence. And two, it's not right. You could be looking at over your shoulders post-closing, be worrying about a lawsuit or something like that. So you got to make sure that it's done right.
Yep. And, we've seen some crazy stuff, I think, over the years from a financial standpoint. But, our job is to normalize it. Our job is to provide a unbiased third-party broker opinion of value on what we think the business will be able to sell for. And the more organized that financials are, the cleaner that they are, obviously, the better they're trending upwards. But
clean and organized. Yeah. Clean and organized. And you know what? I got to say this too, Carey. The only two people that should do a valuation for you is an experienced, seasoned business broker / M&A advisor, somebody that sells businesses for a living, or number two, an actual business appraiser. CPAs, financial planners should not be doing business appraisals. I see it all the time. Business owner will be like, I already know how much my business is worth. And I say, how do you know? And they say, oh, my CPA told me. And I'm going to tell you, I think one time in my entire career, the CPA was even in the ballpark. And the thing is, they got lucky because it was a financial planner. They got lucky because they added back some things they shouldn't have added back, and they added back, and they didn't add back some certain things. And so then how they applied the thing, they were off, but they were off in a lucky way.
Yeah,
I'm gonna say, but you should not. The only two people is a business appraiser / M&A advisor or a business appraiser should be the ones doing a valuation on your business. CPAs, financial planners, Uncle Bob should not be doing that. And I think one of the worst things that's happening too is that you go to an industry conference and you're hanging out at the bar with other people in your industry. You're having a beer and having a drink and you're having a good time. And people are saying, oh, you hear so-and-so sold for X multiplier and da-da-da-da-da.
That becomes the gospel.
That becomes the gospel. Yeah. And then, that bar talk and it gets blown out of proportion and it always gets, escalated in what it is. Yeah. And, throw all that out the window.
Yep.
Throw it out the window. Get it done right. Get it done right. Or somebody like us,
yes,
that's seasoned and experienced.
Hopefully from joining in today, you understand that the financial aspect of selling your business is critical. And we're here to provide any education or information that you need to help you understand what the financial health of your business is. And we appreciate you joining us on this episode of Boss Talk.